Kitco News special coverage of the Denver Gold Forum is brought to you by New Pacific Metals.
I'm here with Lawrence Lepard, managing partner of the EMA Fund. Welcome to the show.
Thank you. Very nice to be here, David.
Very nice to meet you. Finally, your first time on Kitco. Now, your fund manages money exclusively in what you call sound money investments, gold, silver, miners, a little bit of Bitcoin. We'll talk about that. I want to get your macro thesis first and foremost by playing a little game. So I'm going to read you a statement. Tell me 1 to 10, from 1 being strongly disagree, 10 to strongly agree. Okay? So S&P will reach 6,000 points by year end. We're at 4,400 right now.
Medium disagree. We could have a crack up boom, could, but I think 6,000 is a little aggressive.
Goal to hit 2,000 by year end.
I think that's possible. I'd rate that about a 6 or a 7.
Okay. Inflation is going to go higher from current levels. We're at 5.4% latest reading for CPI.
No doubt over the next few years. Might be a little bit of a trough in the next couple of months. It ran pretty hard and they may be able to control it a little bit.
The miners' valuations will catch up to the rest of the equity markets by year end.
Well, I sure hope so. It's long overdue. I mean, there's a tipping point that has to occur, and there's a recognition point that has to occur.
Right. We'll talk about mining and mining companies' valuations. And finally, monetary policy. The Fed is likely to taper by the end of the year.
Yeah, I'd rate that probably a 6 or a 7. There are a lot of people who think they can't because if they do, it'll kill the equity market. They might have figured out a workaround, and I think they're pretty terrified of inflation. So they might, Luke Roman's done a nice job of pointing this out. They might have a backdoor way to taper, but not really taper.
The underlying assumption here, from all the people telling me that they can't taper because equity markets will react negatively, is that the Fed cares about the equity markets, right? That's the underlying assumption.
Yes.
Is that true?
I strongly believe that's true, and there's a lot of evidence to suggest
that. It's not their mandate, though.
No, it's not. It's not written down, but it's been talked about. Janet Yellen's talked about it multiple times. I mean, she made a comment that she basically said she thought the Fed, one of the tools the Fed should have is the right to buy the equity markets. And I think it's highly likely that they actually will. They'll call it something along the lines of the 401k or the IRA U.S. IRA protection plan. Japan does it, and Switzerland does it. And so, I think a falling equity market would, I believe, be a threat.
I don't understand why the central banks have to get involved with the equity markets.
Well, you and I both, right? I mean, in a purely capitalistic society where the government wasn't running everything the way it is today, I would share your belief. I mean, why should they be doing this? But what we've created here is just an enormous credit bubble that needs to be fed. Yeah. And any crack in the bubble, I believe it's perceived as almost an existential threat to the existence of the system they've got.
Okay. Yeah. All right, let's talk about sound money.
Yeah.
And your
I love that topic.
and your emergence into the sound money space. Now, you were telling me a bit about your background, so just for the viewers who may not
I'll make it really quick because I've told this story many times. I spent most of my career as a tech investor from the early 80s until 2003. I got lucky. I got into the internet in 1993, did some private internet deals, worked out really well. I kind of retired in 2003, but didn't. I was doing investing on the side. And then 2008 hit, and I realized that the assets I had accumulated were at great threat of being severely debased because the government had just totally changed the rules. I mean, zero interest rate policy, enormous money creation, et cetera. Inflation became a very, very clear threat. And so as a result of that threat, I pivoted and learned how to invest in mining stocks, not very well at first. But I've been in mining stocks now since 2008. And the reason for that is I think they're the best equity vehicle for protecting against an inflationary environment. So I self-educated in the mining space, and I still believe that to be true.
Okay, let's touch on that point first. Mining stocks as a vehicle to hedge against inflation. Well, inflation went up this year, mining stocks went down more dramatically than some might expect it to. Can you explain why?
No. It's a great question. Everybody's frustrated about it. Yeah. I mean, look, markets breathe and nothing's linear. And one has to take a longer term time frame, right? And recognize that you get these quick zigzags, up and down. I mean, mining stocks went up enormously last year.
That's right.
And we're correcting off of that. I mean, my fund was up 126% last year. This year I'm down 13% year to date. So, things breathe.
While you're still beating the gold miners index.
Yeah, by a bit. I think it's down 20 or something. But the point is that the stocks breathe, and everything breathes. I mean, the thing that I find interesting is the narrative that it's transitory, the inflation's not a real paradigm shift, and that we're going to go back to the 40 years of deflation that we enjoyed from the 80s. I think that narrative is wrong, but I don't think everyone's come to accept it. It kind of reminds me of the early 80s when I was buying stocks, and everybody thought stocks are a bad investment because for the past 15 years they'd been a bad investment. And so, the notion right now, I think the prevailing belief is that we will return to a deflationary economy because in the modern world, that's the natural state of things. And I think that belief is incorrect. And I think as it becomes more and more obvious that that's incorrect and that we've hit this monetary tipping point, as Ronnie Stofferle says, yes, I think these stocks are going to come back with a vengeance. I mean, all we really need to do, in my opinion, is get through 2000 on the gold price. I mean, and it's interesting. This reminds me so much of the 1980 or the 2008 period. So gold hit a high of $800 in 1979-80, went down to 250, came back up to 800 in 2008, and it spent a long time zigzagging around that because it was an old all-time high. It was very hard to get above that. It went through that, and then it went to 1900. Okay, so keep the 1900 in mind. Went to 1900, then it corrected down to 1,000. We're now back at the 1900. We went through the 1900 last summer, okay? We've come back off of that. But again, not as deep. So what you see here are higher highs and higher lows. When we go through 2000, 1900, the last high of 1900 was in 2011. When we go through 2000, sometime in the next 6 months, in my opinion, this thing's gonna take off like a scalded dog. I mean, go look at the Michael Oliver interview on Liberty and Finance. It just came out within the last 2 weeks. And read his, listen to it. He's a brilliant technical analyst. Listen to his analysis of this. And what you'll see is that we are going to have these numbers go much, much higher and not that far away from here.
Okay, so let's talk about $2,000 gold in just a bit.
Yeah.
The miners, though, it seems to me they've been hit harder than they should have been. I mean, if you take a look at the gold price, it's down 3-4%. If you take a look at even the large miners like Barrick, it's down 20% from its highs.
Absolutely.
How does that make sense?
It doesn't make sense, but it does in one sense, and that is these are very highly volatile securities, and this is a difficult business. Yeah. I mean, this is breaking rocks, and it's not simple. I mean, it's not SaaS where you have nice recurring revenues. You have to replace everything that you mine every year. You have to have a good management team, et cetera, to make a good profit in the mining industry. But furthermore, I think the thing that really has got investors upset, or the reason that people are so skittish, is that they've been burned many, many times in the mining industry. They had a huge run from 2000 to 2011, then they got crushed from 2011 to 2015. I know because I was there. Right. Okay, they had a nice bump up in 2016, then they came down hard in 2017-18. I mean, this is like Charlie Brown and Lucy in the football, right? I mean, the mining stock and the poor mining stock investor, I'm one of them, we feel like we're Charlie Brown. And so, yeah, we had this nice run up and we made all this money and Lucy's about to grab the football again and we're going to get screwed, right? I mean, I think that's what's going on. Yeah. And I think what we need to have is once we get through 2000, then the Reddit crowd's going to come on, and hope, and the big institutional money is going to come in. People are going to say, when the big institutional money realizes that inflation is not a transitory event and that we are no longer in a deflationary environment, they are going to start to move money into this space. Get this, David. There's $400 trillion of fiat assets in the world, okay? Cash, bonds, and stock. There's $1 trillion of mining stocks, gold mining stocks in the world, okay? What happens when just a part of that 400 says, there's some inflation here and I'm getting killed and my Facebook isn't going up as fast and my Tesla's not going up as fast, my triple Qs aren't performing as well as they used to. Boy, these gold stocks were up 30% last year, 40% last year. Maybe I need to own some of that. That's 400 that can chase a trillion. I mean, it's going to be explosive, in my opinion. It's really going to be explosive.
Do you think, just on money valuations, do you think valuations of some of these companies like Barrick, Newmont, the larger senior producers, they're even factoring in, we're reflecting $1,800 gold right now?
No, not even close. I think if you were to go to Toronto and ask what the consensus estimates for the next several years future gold prices, people would be saying 1,600, 1,650. I'm still seeing people build models at 1,600. We're never going to see 1,600 again. We're going to see 2,000, and probably within 6 months.
People are building discounted cash flow models using $1,600.
$1,650, yeah. Okay. It's very standard. Well, one of the things that the industry does is they take like a 5-year average of the gold price. So, last year was good, this year's okay. I mean, and here's the thing I find very interesting. The gold miners I see here, they're all like $1,800 gold. I mean, we died and went to heaven. 3 years ago, this stuff was selling at $1,300. If somebody had told us 3 years ago that we were going to see $1,800 gold, we'd have said hallelujah, right? And they're making huge cash flow, huge positive cash flow, and yet the stocks are behaving as if they're, as if they're dogs. They're just, the stocks aren't moving.
So we're at $1,800 gold today. You think that once gold hits $2,000, which is roughly about 11% appreciation from today's levels, then the mining stocks are going to take off.
I think that's the trigger point, and it's because there's a lot of finance today is driven by these algos and these models, these 200-day moving averages, and when the 50 crosses the 200, and it also tends to be driven a little bit by when things take out old highs. Yeah. So the old, 11 years ago the high was 1900. Last year the high was 2070 for a few minutes, and the closing high was a little 2030 or something. This year we're at 1800. We dipped down below that, but we're kind of steady at 1800 right now. When we go through that 2000 again, everyone's going to be like, oh, inflation's not transitory. Oh, gold is telling us that we've got a serious inflation issue. We're going to be at 3,000 before you know it. And these companies make good money at 1,800, and they have relatively, they're all seeing inflation as they're reporting, but they have relatively fixed operating costs. Like you have a $1,000 ASIC, and you're selling your product at 1,800, you got $800 a margin. You sell your product at 3,000, you're going to have $2,000 a margin. All their profits are going to double, right? And these are, and I'm looking at companies here that have cash flow multiples. I'm buying companies that are trading at 3 times cash flow, which is an insanely low number, right? Look at the rest of the market, right?
Okay. Now, $200 upside is about 11% appreciation. That's not a lot. What's going to get us there? What's the trigger for that 11%?
Your guess is good as mine, because it's really a human psychology thing. It's when the mass of people realize that the Fed's wrong, that they're trapped, that they can't stop printing, and that inflation is relentless. Right. That's what I think. I think the thing that people are doing, and it's human nature to drive in the rearview mirror. You look at how things have been, you assume that's how things are going to be. It's just very, very common. And we have not had an inflation problem in this country, or really in the world, for 40 years. And I know what inflation looked like. I lived through the last one. And once it starts, it doesn't stop, and it can get relentless. And then you can get fear-based, and then it builds on itself. And it's a vicious cycle. And so, in my opinion, that's going to happen. We have set the table for that to happen. And the Fed's saying it's transitory, and Fidelity surveyed their money managers, or maybe it was Goldman, surveyed their money managers, and 70% believe the transitory theme. Yeah. And it's wrong. It's just blatantly wrong.
Do you think fiscal policy can help markets, equity markets, gold markets at all? Because let's take a look at the Democrats' narrative, for example. They want to raise taxes on the rich. In fact, they're already passing legislation through the House as we speak about raising corporate taxes and capital gains taxes on investments. Corporate taxes will be raised on those households with over $400,000 of income. That's happening right now. Yeah. Is that going to have any severe impact?
Well, I try to avoid politics, because my view on all these guys, both sides, everybody, is a pox on all their houses. I hate them all. Okay, I'm a libertarian. I think that all of what they're doing is wrong. Are these people in general going to mess things up further? Oh yeah, we can count on that. And are these taxes going to hurt? Yeah, because we've got the worst of both worlds going on right now, because underlying this all, the economy's not that good. The economy looked good because, this is like we took the guy who was, close to being dead, and we gave him a shot of adrenaline, when COVID came along. And yeah, you put $3 trillion into any economy, it's going to look better for a while, right? But that's going to wear off, and they're either going to have to put another one in, or we're going to have a punk economy. And so, punk economy, and then you could say, and by the way, that's part of why the deflationists are saying, okay, Larry, you're wrong. We're not going to have persistent inflation. If the economy gets punk again, the inflational control will come in, but that's not necessarily a guarantee, because you got supply chain issues, and more importantly, it's filtering into lots of areas like labor. So you start to increase labor and pay rates. I mean, those people don't, it's not like you roll that back. Yeah. Right? And then they see what they're buying and it costs more, and they say, hey, I need a higher wage to pay for what I'm buying. And so, it becomes a psychological cycle. So it's a problem.
You said you worked as an investor in the early 90s throughout the 2000s. So you've lived through the tech bubble of the early 2000s. Do you see any parallels to today?
Oh, absolutely. And this one's even bigger. So there've been, it's really tragic what the Fed has done here by messing around with the money supply. Okay, they've created 3 bubbles within a 25-year period, right? So first the tech bubble, because Greenspan was afraid of year 2000, and before that when they bailed out LTCM and all. Then secondly, the housing bubble. So they, Bernanke basically said, we had a fallout from this tech crash, so we're going to take interest rates down so people can, take home equity loans and build their house. And so that created the housing bubble. We all know how that ended, not well. And by the way, each of those reduced the S&P by 50%. So these stock investors, retirees, people who had their money in stocks hoping that was their savings, or they, had over-leveraged on their house, they all got hurt very badly. Right. And now we've created the everything bubble, right? And it's even larger. It's almost an order, well, it's not an order of magnitude, it's much larger than the underlying housing bubble was. And it's in everything, and it's at the highest level, which is the sovereign debt and the sovereign currencies. I mean, and there's no Deus Ex Machina. I mean, we're not going to get solved by somebody from Mars. We can't create a bubble at a larger level. And so this bubble has a couple of possible outcomes. It can burst like the others, but I think the people in charge know how dangerous that is for their political lives. Yeah. Or we can inflate our way out of it. So I think it's an almost guaranteed fact that they will do their very utmost to make us inflate our way out of it.
Well, back in the early 2000s, late 1990s, before the tech bubble bursted, people were measuring tech companies on ridiculous valuation metrics, like price per click on the site or something stupid. They were making no money. Absolutely. Now today we've actually got tech companies that do make money: Amazon, Facebook, Google, and so on and so forth.
They're monopolies, but they do make money.
So do you think those companies are in jeopardy as well, or is it a smaller ones?
Well, they are because they're overvalued. Yes, and part of what look, I mean, classic business theory, right? The capital asset pricing model is based on the notion that risky equity should provide a return over and above the risk-free rate. When the risk-free rate is 0, which is basically what it is today, then by definition, every equity ought to be at an infinite price. I mean, equities are worth infinity because you're not dividing by an interest rate. And so that's a bubble by definition. And it will end. Herbert Stein had the great law. I mean, if something can't go on forever, it's going to end, right? So this bubble will end, but we don't know how. We don't know if it's going to be in a spectacular crash of the equity market and then a flood of money, and therefore initial deflation, then a flood of money afterwards, or if it's going to be in kind of the mush zone where, or even if it's a crack-up boom. I mean, it's entirely possible that they are going to just keep on doing stim. The Fed balance sheet is going to go to 100 billion or 100 trillion, and gasoline's going to cost $100. I mean, we could go the Venezuela route, where they keep the system going, but the inflation, I mean, we're not just talking 3 or 4 or 5% inflation. Of course, that's what they report, but in reality, it's closer to 10. It's a problem.
Let's close the conversation back on sound money now. You've given me a few assets already: gold, silver, mining companies, oil. You also mentioned to me offline Bitcoin.
Yeah,
Bitcoin.
I'm a big proponent of Bitcoin, and unfortunately, a lot of people in the gold business, don't take the time to understand and study Bitcoin, and they should. And it's tricky because there are a lot of, quote unquote shit coins and other alternatives. There's a lot of pump and dump. I mean, crypto is full of a lot of messy stuff that leads typical sound money investors to go, oh, that's all bullshit. I'm not even going to look at it. Okay? That's the wrong conclusion. You should look at the core base crypto out there, which is Bitcoin, and you should recognize what it is technologically. And what I would say that is it's an incredible innovation. Because if you think about what money is nothing more than a ledger. I mean, before we had gold or currencies or anything else, we sat in caves and we kept score of, I killed 1 bison, you killed 2 bison, you owe me 1, etc. So money is just a way of keeping track of who owes who what, right? And if you can create a digital ledger that is immutable and can't be cheated on, that's arguably even sounder as a form of money than gold, because it's triple entry accounting. Everyone can see it. Whereas with gold, they've managed to corrupt the gold price because the central banks have got control of the banks, and the banks have control of the gold, and they've created a lot of paper gold. So in a sense, what that makes is it makes Bitcoin as there's the loudest monetary fire alarm in the system right now. So, one of the things I would say to you is most gold bugs feel the way I do, which is they're astounded that here we are with the most massive money printing operation in the history of the world. I mean, 30% of the money in existence has been created in the last 1.5 to 2 years, right? And yet gold's not at all-time high. I mean, what's up with that, right? I mean, it should be, and yet Bitcoin noticed. I mean, Bitcoin went from 10 to 60, right?
Well, people argue there are 3 characteristics of money.
Right.
Something has to be a store of value, something has to be a medium of exchange, and a unit of account.
Right.
All 3 things have to be satisfied. Do you think Bitcoin meets these characteristics?
Absolutely. Bitcoin meets them all in spades. In fact, arguably, because its stock to flow is going to be, with the next halving, its stock to flow will be better than gold's. It's arguably better than gold in terms of, the other 2 characteristics it meets as well. The only thing it doesn't meet, it's not as easy to transact in today, although it's easier than gold. I mean, people aren't using gold coins to do transactions, but that's all going to get solved. I mean, go look at Strike, go look at Jack Mallers, go look at the Lightning Network.
Yes.
They're going to solve that. So, yes, I do think that Bitcoin is emerging as a very important form of sound money. Yeah.
Excellent. Excellent thoughts, Lawrence. Thank you very much for coming on the show.
Thank you for having me on. Enjoyed being with you. Thanks.
It's a pleasure. I'll speak to you again soon.
Okay.
And thank you for watching Kitco News. I'm David Lynn. Stay tuned for more at the Denver Gold Forum.
Kitco News special coverage of the Denver Gold Forum is brought to you by New Pacific Metals.